Welcome back, dear students and scholars. In video 3, we stopped at the recoverability screen. Now we are picking up exactly where the accounting work becomes measurable. If undiscounted expected cash flows are below the carrying amount, the asset group is not recoverable under ASC 360. That does not mean we record the cash flow shortfall. It means we now measure fair value, calculate the impairment loss, allocate the loss across the asset group, record the journal entry, and update the financial reporting. This is where impairment moves from signal to statement impact. Before we go further, let us define the boundary of this video clearly. We are dealing only with held and used asset groups after the recoverability screen has failed. That means we are still in the operating asset model, not the held for sale model. In this lesson, we cover fair value, loss allocation, journal entry recognition, new cost basis, disclosure, tax effects, and close controls. Held for sale classification, disposal accounting, abandonment, and idle assets are reserved for video 5. Keeping the models separate is a big part of getting ASC 360 right. Here is the learning path. First, confirm that the recoverability screen failed. Second, determine fair value using ASC 820 discipline. Third, calculate the impairment loss. Fourth, allocate that loss to the assets in the group. Fifth, post the journal entry. Sixth, update future depreciation based on the new cost basis. Seventh, disclose and document the result. The memory hook is simple: fail, value, loss, allocate, entry, depreciate, disclose. You cannot jump to the entry before the allocation is complete. Accounting is not a cooking show where we say, and here is one I prepared earlier, unless the worksheet actually ties. ASC 360 uses a two-step framework for held and used impairment. Step 1 is the recoverability screen, which compares carrying amount with undiscounted expected cash flows. That screen is a threshold test. Only when carrying amount is greater than undiscounted expected cash flows do we proceed to step 2. Step 2 measures the impairment loss using fair value, not undiscounted cash flows. This distinction is critical. The screen answers, is the asset group recoverable? Measurement answers, how much loss should be recorded? Once measurement is triggered, ASC 360 points us to ASC 820 for fair value. Fair value is an exit price at the measurement date based on an orderly transaction between market participants. It is not the entity's own wishful selling price, and it is not the cost to replace the asset. The measurement should reflect market participant assumptions, normal market exposure, and conditions at the impairment measurement date. This is why valuation support matters. A fair value number without support is not fair value. It is just a number wearing formal clothes. Before calculating the impairment loss, make sure the carrying amount is correct. Start with the gross historical cost of each long lived asset in the group. Subtract accumulated depreciation through the measurement date. Subtract any prior impairment already recognized. Also, make sure assets and liabilities governed by other US GAAP guidance have been adjusted first. Receivables, inventory, investments, pensions, or other items do not wait for ASC 360 if their own standards require measurement. A clean carrying amount is the foundation for a clean impairment calculation. The core formula is straightforward. Impairment loss equals carrying amount minus fair value. But remember the condition. This formula applies only after the recoverability screen has failed. The loss reduces long lived assets in the group, such as property, plant, equipment, right of use assets within the ASC 360 scope, and finite lived intangible assets if included in the asset group. It does not reduce receivables, inventory, or unrelated liabilities. Those items follow their own accounting models. Now let us introduce the original 2026 manufacturing case. A packaging line loses its largest customer contract and management identifies an impairment indicator. The asset group has a carrying amount of $9.8 million before impairment. Its undiscounted expected future cash flows are $8.9 million. Its fair value, supported by appraisal and market participant assumptions, is $7.6 million. These three numbers will drive the sequence: screen, measurement, allocation, entry, and new cost basis. The recoverability screen fails because the carrying amount of $9.8 million is greater than undiscounted expected cash flows of $8.9 million. That tells us the asset group is not recoverable. But the $0.9 million difference is not the impairment loss. That is only the screen shortfall. The recorded impairment loss comes from comparing carrying amount with fair value. This is one of the most common mistakes in ASC 360 questions, so keep the two steps separate. With the screen failed, the company now estimates fair value. ASC 820 gives the measurement lens and the fair value hierarchy. If observable market quotes for identical assets exist, those are strong evidence. If not, the company may use independent appraisals, comparable sales, or present value techniques. When discounted cash flow models are used, the assumptions should reflect market participants, including a market participant discount rate. The valuation should not simply preserve management's internal optimism. Valuation is evidence, not motivation. The impairment loss is now measured. Carrying amount is $9.8 million. Fair value is $7.6 million. The impairment loss is $2.2 million. That amount is recognized in the current period and then allocated across the long lived assets in the group. Notice again that the loss is not $0.9 million. The $0.9 million amount told us measurement was required. The $2.2 million amount is the recorded impairment loss. After measuring the total loss, we allocate it to the individual long lived assets in the asset group. The general rule is pro rata allocation based on relative carrying amounts. But there are two important constraints. First, only long lived assets absorb the ASC 360 impairment loss. Second, an individual asset cannot be written down below its separately determinable fair value if that fair value is available without undue cost or effort. The allocation must respect the asset group boundary and the fair value floor. Here are the allocation inputs. The asset group contains three long lived assets. The primary line has a carrying amount of $5.0 million. Support equipment has a carrying amount of $2.8 million and it has a separately supportable fair value floor of $2.4 million. Leasehold improvements have a carrying amount of $2.0 million. Total carrying amount is $9.8 million, which ties back to the impairment case facts. This tie-out is the first control check. The first allocation is tentative. We allocate the $2.2 million loss based on relative carrying amounts. The primary line is about 51.02% of the group, so its tentative loss is $1.122 million. Support equipment is about 28.57%, so its tentative loss is $0.629 million. Leasehold improvements are about 20.41%, so their tentative loss is $0.449 million. The tentative total loss is $2.2 million, and the tentative new total carrying amount is $7.6 million. Now we check the fair value floor. The tentative allocation would reduce support equipment from $2.8 million to $2.171 million. But we have separately supportable fair value of $2.4 million for that asset. ASC 360 does not allow us to reduce that asset below its fair value floor. So support equipment can absorb only $0.4 million of impairment. The excess $0.229 million must be reallocated to the other assets that do not have a separately determinable floor in this case. After applying the fair value floor and reallocating the excess, the final allocation is complete. The primary line receives $1.286 million of loss, reducing it from $5.0 million to $3.714 million. Support equipment receives $0.4 million of loss, reducing it from $2.8 million to $2.4 million. Leasehold improvements receive $0.514 million of loss, reducing them from $2.0 million to $1.486 million. Final carrying amounts total $7.6 million, which matches the asset group fair value. That is the control tie-out. Now we record the impairment journal entry. Debit impairment loss long-lived assets for $2,200,000. Credit accumulated impairment primary line for $1,286,000. Credit accumulated impairment support equipment for $400,000. Credit accumulated impairment leasehold improvements for $514,000. The total credits equal $2,200,000, so the entry balances. The credit may be recorded directly against the asset accounts or through accumulated impairment accounts, depending on the entity's system and policy. After the entry is posted, the adjusted carrying amounts become the new cost basis for future accounting. The primary line now has a new basis of $3.714 million. Support equipment has a new basis of $2.4 million. Leasehold improvements have a new basis of $1.486 million. The company does not continue depreciating from the old carrying amounts. The fixed asset subledger must be updated component by component because all future depreciation, future impairment testing, and eventual disposal accounting will start from these revised amounts. Depreciation after impairment is prospective. The impairment loss is recorded in the current period, and then future depreciation is based on the new depreciable amount, any revised residual value, and the remaining useful life as reassessed at the measurement date. The company does not go back and restate prior depreciation just because the asset is now impaired. The formula is future depreciation equals new depreciable amount divided by remaining useful life. The impairment entry changes the future expense pattern, not the past. Under US GAAP ASC 360, impairment losses on held and used long-lived assets are not reversed. Even if fair value later increases substantially, the entity does not restore the previously recognized impairment loss. The reduced carrying amount remains the new cost basis. Future depreciation continues from that basis. This is a major contrast with IAS 36 under IFRS, where certain impairment reversals may be permitted. Under US GAAP for held and used assets, impairment is a one-way gate. Once you walk through it, there is no polite accounting U-turn. Reporting and disclosure help users understand what changed and why. Impairment losses on held and used long lived assets are generally reported within income from continuing operations unless another presentation rule applies. Disclosure should describe the facts and circumstances leading to impairment, the amount of loss recognized, the asset group or class affected, the fair value method used, including ASC 820 level, and key assumptions, and the reportable segment affected when segment reporting applies. The goal is transparency, not just compliance. An impairment loss can also create tax effects. Book carrying amount decreases immediately when the ASC 360 impairment is recognized. Tax bases may not decrease at the same time because tax deductions for asset write downs are often deferred until disposal or until another tax rule permits deduction. In this case, book basis falls from $9.8 million to $7.6 million. If tax basis remains higher, a deductible temporary difference may arise. Under ASC 740, the entity evaluates and measures any deferred tax asset, including realizability. Impairment recognition is a significant estimate, so the close process file must be strong before the entry is posted. The file should include the indicator memo, approved forecast support, valuation support, allocation worksheet, fair value floor check, tax review, disclosure draft, and controller approval. The posted amounts should tie to the fixed asset register and the allocation worksheet. This is not the kind of entry where someone should say, "We will find the support later." Later is where audit issues are born. Let us recap video 4. Once the recoverability screen fails, measure fair value under ASC 820, calculate the loss as carrying amount minus fair value, allocate the loss pro rata with any fair value floor, record the journal entry, establish the new cost basis, depreciate prospectively, and remember that reversal is not allowed under US GAAP for held and used assets. In video 5, we move to held for sale classification, disposal group measurement, abandonment, and idle asset accounting. If this lesson helped you connect the calculation to the journal entry, please like the video, subscribe to the channel, support the course, and share it with colleagues who are learning US GAAP in a practical way.